Today to be hosting the Washington release of this year's Geneva report on the world economy, and yet it moves, inflation and the Great Recession. Our speaker will be Ugo Panizza, who I will come back to in a moment. As many of you are aware, particularly central bank groupies of my ilk, the Geneva reports on the world economy last year, you may recall that Joe Gagnon and Patrick Honohan were contributors to the talk about what can central banks do now. And this year, in addition, as always, these are co-authored by a distinguished group of international scholars representing different perspectives. This year's report, in addition to Ugo Panizza, includes our former colleague, Angel Ubide, as one of the 5 co-authors. And so, again, we feel a certain tie. But this report, of course, stands on its own merits. The report is the 19th edition, will focus on how low and stable inflation has been experienced now, looking back at the last few decades, but also wondering how much we should read into the fact that inflation has been persistently below central bank mandates for some time. Some of you may recall that Olivier Blanchard and Larry Summers had here our Rethinking Macro Policy conference a couple months ago, and Olivier and I, among others, were on a panel at the opening of that. And I gather there was across the street at Brookings some more discussion the other day with Ben Bernanke and Olivier and others. This is a very timely issue, how to get beyond the inflation thing, I'm getting very accurate. Let me restate it more precisely. The mentality and the sense of achievement that many central bankers have and the received wisdom was that anchoring of low inflation and low inflation expectations was a huge accomplishment, very difficult to do, hard won, and should not be put at risk. While I think most people would agree with parts of that, many of us are prepared to challenge that in ways after the experience of the last 10 to 20 years that we were not. And speaking just for myself, as I did at the Macro Policy Conference, I found discussions of whether we should radically change our policy to target 3% instead of 2%, or come up with hypothetical contingent expansion policies based on definitions to be very small beer compared to the challenge that we've faced. And it's in this light, since my opinions don't matter, that I do want to welcome Ugo Panizza, Professor of International Economics at the Graduate Institute in Geneva, for presenting the findings of this report, because I think the authors have done some real work in getting beyond the simply can we recalibrate the inflation target a little to think about what this low inflation actually means, both in terms of economic effects and in practice for central banks. Professor Panizza is the director of the Graduate Institute's Center on Finance and Development. Many of us knew him much before as chief of the Debt and Finance Analysis Unit at UNCTAD, the United Nations Conference on Trade and Development. He's previously worked at the Inter-American Development Bank and the World Bank before turning into an academic. But as this report shows, there's a lot more to this than just academic research. I think in one of the most interesting aspects that he'll be talking about is the idea that the Great Moderation preceded the Great Recession. The report analyzes whether this long period of low inflation we're experiencing could lead to a surprise bout of inflation in the coming years. So let me turn it over to Professor Panizza. Thank you for joining us today. We are very proud to host the American premiere of this report, and this is on the record. And remember, Ugo, to wave hi to all your fans on the internet watching virtually.
Thank you, Adam. Thank you to everybody for being here. I think if my daughters are watching this, they will put them to sleep much faster than their usually bedtime reading. So there is a pointer here. So as Adam said, this is a joint work with David Miles, who is at Imperial College, but was for a few years in a job that Adam had. So was in the Monetary Policy Committee of the Bank of England. Ricardo Reis, who is at the LSE, and Angel, who is at Goldman, but was here at the institute. oops, wrong direction. So this was the view in the 1970s. So this is James Tobin presidential address to the American Economic Association, and says, everybody is worried about inflation. And if you go and talk with the men of the street, people don't seem, of course, central bankers, and this crowd is worried about inflation, but if I talk with my parents, they don't think much about it. And this must be because inflation has been low and not very volatile, and it has been also low and not very volatile in the aftermath of the biggest macroeconomic shock that we had in advanced economies since the Great Depression. So, and just to give a preview of, so when we started this report, we were discussing whether to emphasize the fact that inflation has been stubborn, so sort of a negative connotation, or whether it has been stable. And we sort of ended up with the more positive interpretation, and this sort of the report, it was, good luck or good policies, and some people told us, well, maybe you should have titled it bad luck or bad policy. So our view is that the outcome with respect to what it could have happened was fairly positive. So that's sort of one of the messages of the report. Now, we wanted to start with the longest possible history of inflation. So this is the Bank of England as this data going back 350 years on inflation. And this is a graph. So the red line is the annual inflation going back to 1660, and the black line is a 10-year moving average. And if you look at over this very long period, average inflation was low, was 1.5% on average, but it was very volatile, so standard deviation of 6.5%. And if you break down, this very long period in sub-periods, so first you have the gold standard, which de facto started with when Isaac Newton was the controller of the mint in 1717, actually, but the euro about 100 years later. So you had low inflation, very volatile. Then you had the wars with the two wars and the interwar period with the Great Depression, which, inflation 3%, super volatile. The Bretton Woods period with inflation about 5%, some moderate level of volatility. The period between the end of Bretton Woods and the crisis of the European monetary system, again, high inflation, 9% and volatile. And then you had the Great Moderation, which was moderation. We had moderate inflation, so 2%, and incredibly low volatility. And then we had the global financial crisis and the aftermath of the crisis. And in England, in the UK, inflation was just above 2%. It was lower than that if you look at other advanced economies. Volatility was twice as high than during the Great Moderation. It was still very low. And if you look at other advanced economies, well, we don't have this long series, but things look more or less like this. The inflation outturn after the global financial crisis was not as good as during the Great Moderation, but it was not a complete disaster. And in this sense that we emphasize, we say, it could have been worse. And this is sort of the title of the report, that inflation moves. And so there was yet it moves, and if you look over a long period of time, it moved a lot, and it has been a success of modern central banking to keep inflation under controls. And then from this, again, what I told you before, our view that the inflation outturn was pretty good. So we converged. So we had some discussion about among us, and we end up with this technical description of being pretty good. And the way we sort of make the point that it was pretty good, we say, okay, go back to 2010. So just immediately after the global financial crisis. And, and you sort of, textbook econ, macro 101, and what would the tools of macro 101 tell you about what it could happen to inflation, after 2010? And, and if you think so, sorry, wrong way again. So, if you approach this problem from, the Phillips point of view, say, well, we had a massive output gap. Inflation had gone down below target immediately after the global financial crisis. In fact, some country it touched deflation for a very brief period. And if you saw both the fact that you had a negative output gap, and if you have an inflation was lower, and if you have some type of adaptive expectation, you would expect that inflation could go down rapidly and might be going to deflation. So some people were predicting some sort of deflation spiral. Then you had interest rate, which were basically either at zero or close to the effective lower bound, and were not moving. And again, if you take this, if you go beyond macro 101, but if you take a standard result from Sargent and Wallace, when policy rates don't move, inflation could become, the price level is not determined. So, you could have inflation, you could have deflation, you could have anything. There was an explosion of the monetary base. So bank reserves increased very rapidly, and some people started saying, we're going to have, hyperinflation or high inflation down the road. And then we had a bunch of new policies which were not tested. And again, so who knows what would happen after these policies. Central bank were given new goals in terms of, financial stability. And then there was a rapid increase in public debt in many advanced economies. And again, people think, this rapid increase in debt might lead to monetary finance, might lead to fiscal dominance, and again, might lead to high inflation. So there were all these forces, some of them pointing to low inflation, some of them pointing to high inflation, some of them, pointing to unstable inflation. But then what happened that, now let's see if I get it right, no? Yeah. What happened is that, oops, okay. If you look at the outcome of inflation, so this graph, the solid line is the median inflation in 19 advanced economies, and the gray line is the interquartile range of these 19 advanced economies. Okay, so there was some volatility. As I said, immediately after the crisis, we went very close to zero, and then we bounced back. But there was not this massive either increase in inflation or this deflation spiral that some people were afraid of. And if you go to more sophisticated measures, so this is the measure of pure inflation, which is computed with a methodology that has been developed by Ricardo and Stock. So this is basically you extract all the idiosyncratic shock due to changes in different prices, and you just look at the proportional increase of all prices. So this measure of pure inflation, again, it lowered, it went down after the financial crisis, and it went down by 50 basis points or even 100 basis points. But, again, it didn't go into deflation or very high deflation. So again, some people do this graph. So again, we had some internal discussion. So Hangel was more like, this is a big thing. David said, it's not a big deal, but the fact it was not a massive drop of it. And well, this is core inflation and another measure of inflation computed with the Stock and Watson unobserved components of stochastic volatility, but also this is very similar. So we say, it's remarkable that given the nature of the shock, so I guess the most read piece in Vox EU is the piece by Kevin O'Rourke and Barry Eichengreen. I think it has 1.2 million read, which compare the behavior of industrial production after the Great Depression and the behavior of global industrial production after a global financial crisis, showing that for the first year they were basically the same. So we have a shock which is comparable to the Great Depression. And if you compare, I don't have the graph here, if you compare the outturn in inflation, it's very different. So in the Great Depression, you had true deflation. We didn't have it here. So in the report, I will not go over this because I don't have much time, but we discuss possible explanations of why of why inflation didn't end up being as bad as it could have been. And we emphasize the flattening of the Philip curve. So Olivier Blanchard has written a lot about this. The role of commodity price shocks, the anchoring expectation, and central bank balance sheets. But I don't want to talk much about this. And if we think, so we have a part of the report where we go into various theory and talk about this. What I would like to talk about now is this factor that contributed, are these factors that contributed to inflation to remaining relatively stable and not going into deflation, were the outcome of good policy choices, a good policy implementation, or were just the outcome of bad luck. So this was the bad luck, were just the outcome of good luck. So this was the good luck, good policy story. And so if you look, so we have a long discussion about expectation, and if you look at the behavior of inflation expectation, we look at three types of expectation. We look at markets, we look at professional forecasters, and we look at households. And you see that in all three cases, expectations were always well anchored. There was some loss of credibility in the sense of credibility of the inflation target, in the sense that the anchoring undershoot, the expectation undershoot the target a little bit, but it was not too much. So there was this, and this anchor of expectation contributed to maintaining inflation stable. And our discussion that this is mostly a payoff of good policies and good credibility before the crisis. Another aspect that we discuss is the role of commodity prices, and here we think that was more good luck in a sense that we had a very large commodity price shock, which is really massive if you look at this graph around 2010, exactly when a standard Phillips curve would have signaled that we could have gone into deflation. And again, so we have so this is the JP Morgan Commodity Price Index, which Angel told me he has no clue how it's computed, but he says, whoever computed must have done a good job. Sorry? Goldman Sachs, did I say JP Morgan? Okay, the Goldman Sachs Commodity Price Index. One thing that, that is impressive to when we looked at this graph, that the shocks that we had, recently make, I grew up in the 70s, and I thought that this was a massive stuff, and that's, this looks small compared to what we have now. Yeah, and here, so so this might be central banks played a role because the monetary stimulus might have helped, but this is probably was mostly, good luck and might be expansionary policies in emerging markets, especially in China. And then we have a discussion of what could have explained the flattening of the Phillips curve, and we have a discussion on the role of rigidities, and so here we discuss the role of marginal costs and the fact that there are some theories that tell you that even if you're financing constrained, if you're financial constrained and you value internal liquidity, you might not want to respond to a negative demand shock by lowering the prices. I mean, this would be optimal if you have continuous access to credit, but in an environment of financing constraint, which was, what happened after the global financial crisis, maybe you'd rather lose clients than lowering prices. And this, again, might have contributed to the fact that inflation did not go down. And again, we have some evidence there. This, we think, it was mostly some structure of the economy, was mostly good luck. But, as economists, we always tend to think that, that flexibility is good. In this case, some types of rigidity, both in firm pricing behavior and in labor market, might have helped preventing into deflation. There might be a problem. We might be paying the price now, right? So we had, we might have traded a shallower adjustment, so we didn't have deflation, but now it might be taking a long time to go back where we should be, and this might be part of the explanation. So, Yellen's speech a few months ago when she said, the biggest surprise this year was the fact that there's no inflation. So now, we have been below trend for a long time. The policy mix, again, we have a mostly positive view about what central banks did. Again, some of them were more proactive, so the Bank of England. Some of them were more problematic, especially the European Central Bank. It took them a while to act, and if you remember, at some point they actually acted in the wrong direction, so they increased rates when they should have reduced rates. But in general, our view is positive. We're a bit, this is not a report about fiscal policy, but we're a bit more negative about fiscal policy, the fact that there was maybe some premature tightening in some countries. So this is the cyclically adjusted budget balance in advanced economies. You can see, it went to positive very rapidly when there was still a lot of slack. Okay. So the future. So the future is that, even though by and large we have a positive view of what happened compared to what it could have happened, we are still, so these are graphs that shows the price level in the UK, in the US, and in the euro area, and compare them to a 2% trend. So the UK is pretty much where it should be. In fact, now, this ends sometimes in mid-2017. Probably now they're above where they should be. But both the US and the Eurozone were, in terms of level, were very different to where we should be, if we had kept a 2% target. Okay, so that was so in this part of the future we have a discussion about policies and about maybe more philosophical about the future of central bank independence. We have a small discussion about changing the inflation target, but we don't really talk much about this because this was a big topic of last year's report that Joseph contributed to. So, and also we don't talk much about it because we did not really agree on what it should be done. So so what we agreed at on the fact that there should be a process of periodic reviews, like it happened in certain countries, but we did not agree whether it should be raised or not. Then we have a discussion of whether should central bank live with these large balance sheets, and maybe if there is an opportunity to reduce it, it's okay. If there is no opportunity to reduce it, it's fine as well. Or should try to normalize a shrink the balance sheet. And our view that it's perfectly fine to live with large balance sheets. We don't think that this seems to be what commercial banks demand, and that's fine. We don't think that there is an issue of latent inflation there that this could lead to latent inflation. The only possible problem, which is more of a political problem than anything else, that given that now the central bank have assets which have long maturities and have liabilities which have short maturity, if the interest rate were going to go up, this will lead to losses in, for the central banks. Now, we know that there are central banks which operate with negative capital. The Central Bank of Chile has operated with negative, so it's not a big thing. You can do it, but it might lead to political pressure that could harm the central bank independence. This is, in a sense, what happened. So I live in Switzerland, and there's been a lot of political pressure on the Swiss National Bank when it kept expanding its balance sheet. Okay. So the other discussion is like, do central banks focus too much on inflation? Should they focus more on other stuff, on financial stability? So again, I live in Switzerland, so I live in Geneva, but that the opposite side of Switzerland, there is the BIS, which are much more worried about, financial stability. In fact, Claudio Borio, he has this idea that at this point, central banks have almost no impact on inflation and therefore should target something else. We take a different stance here. We say that there is not too much focus on inflation, that monetary policy should be targeted to stabilize and control inflation, and that for financial stability there are other instruments. There might be cases, so we have a discussion in the report, there might be extreme cases in which you want to use the interest rate for financial stability purposes, but these are very rare and extreme cases. So that's our view on this. Still on the other one. And this is, this is the concluding stage. So again, we're positive, but we are worried about two things. Number one, that this relatively positive outcome, we sort of downplay the importance of central banking, and that this large balance sheet accumulation might sort of put political pressure on central banking and again reduce their independence and ability to act. And in a sense, in this case, we said, it was a mix of good policies and good luck. It might happen again, and in this case, the good luck might not be there. So it's very important that the central bank keep focusing on inflation, on stabilizing inflation, and are free to act. So that's sort of the concluding message of the report. And I would stop here. Thank you.
Hugo, that was a little more of a reassuring victory march than I actually read the report as being. So before I turn it over to our distinguished audience, let me ask you just to consider the following. So one way of unfairly but not entirely inaccurately summarizing your report is inflation didn't move in any of the ways that we would have predicted it would move. Therefore, by default, it must be central bank credibility that caused it to stick, which is one way of looking at the data. Another way of looking at the data is we fundamentally don't understand the inflation dynamics, and the vertical Phillips curve notions of the 70s and 80s, Sargent and Wallace and all that, actually may not have been disproved, but at least runs contrary to almost everything we saw in the last 10, 15 years. So can you just say a few words on why I should believe the this is a proof that central banks did the right thing rather than this is a proof that we totally misunderstood inflation?
Okay, so that's a tough one. So we have seen shocks in other countries with less policy credibility, and we've seen that this reflected in inflation, right? Positive and negative shocks. So I cannot prove that this was central. So one thing is that, again, our view that things were sort of okay. So your view might be, okay, then the shock didn't matter, and that's why nothing much happened, and that's so that we don't understand inflation. But, you know, so we have experience, again, in countries with less credibility, in which you see that shocks reflect into inflation. In there are more shocks, you know, positive demand shock than negative demand shocks, in which, you know, you see a jump in demand and, you know, inflation goes up. So the Phillips curve, if it exists, must not be completely flat. It has some slope. So whether it's fully vertical, well, I never really believed that, but but the fact that the Phillips curve has some slope, and therefore the inflation should react to some shifting of the demand curve, you know, I think.
Okay. A second question, just a little more policy-oriented. Okay. I mean, obviously, you were somewhat constrained by the last couple of years' reports. Mm-hmm. You don't want to reinvent the wheel, even if you agree or disagree with prior authors. But I guess one question coming out of this is, do you think central banks need a different kind of toolkit in order to stabilize inflation, or is this just proof that actually getting all wrought up in the toolkits doesn't matter? All that matters is your focus on inflation, not being distracted by the BIS or by unemployment or other things.
I mean, so I think the crisis proved that you do need, you know, so new tools were created from the crisis, and there is some evidence that these tools were effective. So again, it's always hard to find, you know, the effectiveness at the, you know, you always have an identification problem at the macro level. But, you know, there are a bunch of papers that they show that these new non-standard policies were effective where you expect to be effective. So, you know, were effective in affecting rates and returns and stock returns and so on and so forth. So, I think that the crisis proved that you do need new policies, and new policies were developed. Now, I don't know if a new crisis has different characteristics will require the invention of new and different policies. Probably, yes. So there is this paper in economic policy by Alan Blinder and a bunch of co-authors, which is, you know, is titled "Necessity is the Mother of All Inventions." So I guess that's
great. Let me open it up to our distinguished audience. Jessica has a roving mic up front. There's also a standing mic at back. Please either signal or go to the mic. And please identify yourself when speaking. And as was quoted at AEA this last week, when you stand up to ask a question, it should actually be a question.
Yes, I heard this thing. It's fantastic. The first sentence should be a question, and the second sentence should not exist.
I'm not going to go that far. If we said the second sentence should not exist, we would never have anybody show up for lunch. But at least should be framed as a question. So please. Yes, German, please.
So
that's German Zettelmeyer from the Peterson Institute.
Yes. Thank you so much. So I'm not sure actually whether this is a new question or just a reframing of the first question by Adam. So you make this point that the fact that expectations did not become unhinged is evidence that good policies had a role. But of course, central bank credibility depends on many things, and one thinks of it as being acquired over a long period, so you have some sort of credibility capital. Is there anything in your report that enables you to distinguish between, just the fact that these are credible central banks and that they happen to do the right thing in that moment? So in other words, being very credible central banks, maybe if they hadn't gone through great lengths at finding creative ways of easing a policy, they would have achieved the same result.
No, we don't have anything on that report. What I can tell you that what we have, it might be linked to a question that Adam was asking before, and this is not for this report, but something that I'm doing with Ian Coase at the World Bank, and we are running a bunch of testing of the anchoring of expectations. So how much expected inflation, so this is a standard test, right? How much expected inflation react to differences between expectation at T-1 and realized inflation at T-1. So you have a shock in realized inflation, and you look, and if inflation are well anchored, so the coefficient should be 0, and if they're not well anchored, you should see some things. And what we see there that standard measure of central bank credibility affect this response. So country with central banks which are not credible, you see some less anchored expectations, in the sense that the expectation responds to deviation between actual inflation and the inflation expectation at T-1, while the sensitivity is much lower in central bank with higher credibility. But that's a different question for what you asked. The question that you asked.
Yeah. No, go ahead.
No, the question that you asked, I don't have an answer.
No, but I mean, this is worth just trying to drag out a little bit more, especially since you're doing this. I mean, so Thomas Laubach and I, Ken Kuttner and I, 20 years ago, did those kinds of exercises at inflation targeting and said that extent of shock response was a good proxy for how credible was the inflation target. But time has passed, and so again, I'm sorry, this will be the last time we restate each other's question, but kind of restating Jeremy's question. In going now to you and Dr. Coase's work, is when you say the standard measures of central bank credibility predict this, is that credibility defined as they have a mandate that's solely about inflation? Because that becomes sort of circular, right? So, yeah, it's anchored. It's anchored because they care more about that. But that isn't necessarily an efficiency gain, right? That could just be a preference.
So in that paper, we try many things. So we have this standard, are you an inflation?
Instead of saying standard, why don't you spell out what you do?
Sorry. So are you an inflation targeter?
Right.
Do you have high level of debt or low level of debt? What has been your past history of inflation? So we use 4 or 5 different measures which are used as a proxy of credibility. So, and the results are more or less, consistent across these different measures. Yeah.
Great. Thank you for explaining. Please.
With WIDA. First of all, thank you for a very fine presentation. My question is more on policy. The last 25 years has sort of been the golden age for trade liberalization. GATT-Uruguay round, China joining the WTO, the European Union, a plethora of free trade agreements. And we may be at a tipping point going in another direction, at least from a US and a UK perspective. To what degree has trade liberalization been a moderating force on inflation trends, and what can we expect if the current environment changes dramatically, with at least some of the biggest economies taking a more parochial short-term view?
Okay, so this is a topic on which there is a huge debate, and we don't discuss much about this in the report. But and there are 2 types of question here. is there a level effect of globalization? So that's one question. And the other question, has globalization reduced the ability of central bank to control inflation? Now, the answer to the second question, the standard view, I would say, to which I tend to agree to, but not everybody agrees, and I'll tell you what the most prominent dissenter to this, that central banks, at least in large advanced economies, so the US, the Euro area, England, their ability to control inflation is not affected by, to a large extent, is not affected by trade globalization. So there's theoretical work by Woodford dating back before to the financial crisis. There are a bunch of empirical papers. There is work done at the Fed. The most prominent person who strongly disagrees with this view and claims that at this point monetary policy has no effect on inflation whatsoever because everything derived by global factors is Claudio Borio at the BIS. So but I would say that most people would agree on the view that central bank can still control inflation process, at least in advanced economies. Now, there could be, however, a level effect in the sense that that globalization might lead to lowering price levels for a certain period, and there might be some transition time. So there was a recent speech by Governor Carney, which discusses this effect. There could be a transitory period in which inflation is lowered by the globalization process. But again, the central bank, if it wants, has the tool to respond to these effects.
Let me just complement what Ugo said by offering a slightly different political economy take. So, in a sense, right, there is an alternative channel, which I think there are two alternative channels, one of which I think you're referring to, Bill, by how globalization can affect inflation outcomes. I mean, I'm sure there's a dozen, but two that I think matter. I mean, Ugo gave very much what a mainstream monetary or macroeconomist would think. Two other sort of political economy versions. One is the golden straitjacket, that it's partly about trade, but it's a lot about financial globalization, that if you're in their data set of their other paper, are a misbehaving Venezuela kind of country, you're more likely to be punished with capital flight and high interest rates and peer pressure and all kinds of other stuff if you deviate from the inflation standard. And then the channel that I think you're referring to, or at least how I would see it, is do you have an ongoing, say, deflationary or disinflationary pressure because China, Eastern Europe, parts of India, not just in a one-year shock, but in a multi-decade shock, are entering world markets, increasing global supply, pushing down. Now, the way to bridge that back, and Hugo may disagree with this, but the way to bridge that back to sort of central bank speak, which relates to what Hugo was saying a minute ago, is how much does the central bank accommodate that? So the idea is you can think of it as every year there's a new downward pressure on inflation that you have to take into account in addition to whatever else you're doing to decide on inflation that year. And ideally, if the central bank has a 2% inflation target and China is an ongoing downward pressure, the central bank in the first few years can say, oh, great, this is good. I don't need to tighten as much to get inflation down because I already have this tailwind pushing it down. Or they can say now, oh, bleep, if I want to get inflation back up, I have to actually push harder because I've got this tailwind and I got to do something about it. Why it's political economy is it gets into stuff above Ugo, and I guess my pay grade as well, certainly my pay grade, which is how much has the support for low inflation been through your kind of, let's call it the Walmart effect, which is, I think, what you're referring to, right? So how much is it we all like what central banks are doing, we like the outcomes, because I go to Walmart or Costco or Target or whoever, and Aldi, and the costs are lower. And so therefore, I'm generally not worried about inflation in the sense they said. And maybe if that changes, then the ability of central banks to keep going as they've been going changes as well. Don't know. We have the gentleman at the back mic, and then Joe, and then Morris.
Okay, thank you very much. My name is Ken Nibayashi. I'm an economic counselor of the Embassy of Japan. And thank you for your presentation. And since you talked a lot about inflation and deflation, and since I'm from the Embassy of Japan, I have to ask you about Japan's deflation. I mean, Japan, as you know, has experienced a long time of deflation or low inflation. And despite the commitment by the Japanese government and the Bank of Japan to tackle deflation, and despite BOJ's massive initiatives, including QQE, qualitative quantity easing, and negative interest, Japan is still far from being completely out of deflation. So my question is, how do you see Japan's experience? Is it unique to Japan, or could it happen to any country in the world? And if the latter is the case, what kind of lessons do you think should be learned from Japan's experience? Thank you.
And you can answer from your entirety of life experience. It doesn't have to be what you guys included in this year's report.
So I once read a piece by Paul Krugman who said something like that. If I want to know something about Japan, I talk with Adam Posen.
Yeah, you're very kind to remember that. He's since recanted that view.
I don't know, but that's what. So I'm a bit. So I don't know much about Japan. So I guess Angel among us was the person who knew more about it. So what happened to other countries? My guess is, well, I don't know the counterfactual, but it's not that it could only happen to Japan. So Japan, there are some structural issues with Japan, given to the population trend and so on and so on. But from what Angel told me, and I don't know if Adam agrees on this, when there was a convincing policy stimulus in Japan, inflation reacted. But maybe the stimulus never lasted enough or was never convincing enough. I don't know if that's a right interpretation of.
I mean, largely. Sorry, Ugo's being too kind to me, and I'm talking too much. But just one line on this. My colleagues at the Japanese embassy sort of know my views, but just picking up what Ugo said. I certainly believe that story, that it was insufficient and insufficiently sustained given the headwinds. As Ugo said it, until basically the last year and a half, when I sort of looked at the list of all the things the BOJ had done since Kuroda took over in April 2013 and the global situation, and they did everything they seemingly could do to credibly commit to a higher inflation target, and it didn't quite work. It clearly made some difference. It clearly got them out of actual deflation, but it didn't lead to upward spiral. And so that reinforced, just for me, the concerns that we don't understand the inflation dynamics that well, in addition to that. But I should note, as we're about to turn to him for the next question, our colleague Joseph Gagnon had a blog post, I guess before Christmas, in which you talked about the Phillips curve in Japan, and you argued both in the US and in Japan were just about, if you allow for some flat Phillips curve when you're in a very low unemployment, that there's a kink in it and it goes back up. Is that a fair characterization?
Yes. And it leads to my question. So
perfect.
Joe Gagnon, Peterson Institute. Thanks for coming, Ugo, and talking about this important topic. So I've been thinking that a big issue in stable inflation in the last few years is precisely this downward wage rigidity, keeping us out of deflation, which you gave some prominence to. And you raised the interesting possibility that, well, maybe that, although helped before is now hurting us. And so I think that's interesting. Maybe you could explain a little bit more about how that might work. And my question in particular is, do you have direct evidence of that? Like, it's certain, maybe just anecdotal or whatever, or because you mentioned, well, maybe it's explaining the slowness of inflation now, but you didn't actually say you have, evidence that that indeed is the reason.
No, that's pure speculation. So no, we have evidence, at least, and it's not our research, so based on other people's research, that indeed rigidities have played a role in preventing deflation. The fact that this might explain the low inflation pickup now, it's something which we speculate in the report. So we clearly don't have any direct evidence in the report, and I haven't seen research on this. So this is sort of more, things, you didn't go down a lot, so you're not bouncing up much. So no, this was pure speculation. So it's sort of
Seems like intriguing, well-informed speculation.
no, it's
But yeah, we've still got a ways to go yet. I think Morris Goldstein.
Hi, Morris Goldstein, formerly Peterson and formerly IMF. I wonder if there isn't an explanation that incorporates Adam's point that they didn't really understand the inflation process, but also your point that it was partly good policy. But I think you need a broader explanation. And what I would say is the results appear to be at least consistent with the view that at least on gross tuning,
sorry.
at least on gross tuning in terms of policy, you got it sort of close to right in the following sense. Central banks didn't say when they hit the zero bound, that's all we can do. They did introduce new instruments. On fiscal policy, you didn't have everybody cutting back at the same time and sort of counter-cyclical. On banking policy, you didn't say, well, we're not going to put any public money in, even though these banks are clearly now insolvent. And you didn't have wide-scale competitive depreciation or protectionist policy. So on those four big things, you sort of got it right. I mean, you can quibble that they could have done better on those, but you got the broad outlines right. And if you hadn't gotten that right, you would have had a very different result. So you could still say, well, we didn't understand quite the relationship between monetary policy and inflation, but still, if you hadn't gotten those other things right, you would clearly gotten much different outcomes on inflation, I think, than what you got. So anyway, what do you think of that view?
I mean, so that was more or less our reading of the evidence. But again, the way Adam challenged what we said at the beginning.
Raise the question.
No. It was a very nice question for which I don't have a good answer. So if I understand your question, it's like maybe if they had not done anything, things would have been exactly identical. And we don't have a clear counterfactual for this. Our feeling is along the line of what Morris said, that a lot was done, and this helped, and again, more could have been done. But again, I don't have a counterfactual. But to some extent, though, you see that Europe, who did less and later, things, and the Bank of England, which is, you were already out, I guess, from the Bank of England.
No. I was the one who made them do it.
Okay, so and the Bank of England was more aggressive, things.
I would love to stake a lot on that cross-sectional variation, but I think we can't. Can I ask, there's a couple of you, we've got a mic here, but Jeremy, Prakash, if you could go to the back mic, please, and we'll take it from there.
Yes. Andy Powell from the IDB. I wanted to, the graph which has the 2% trend and then the UK, and the interpretation of that, I just wanted to check with you, because there's one interpretation that kind of worries me. So, because you seem to imply the US, for example, is clearly below the 2% trend, but the last points, probably the trend is getting close to 2% on the core inflation. But you seem to imply that the US should somehow be back to the line. And that implies not 2%. That implies going above 2%. And there are some people that argue, wow, you should be as much above as you are below the target, which I've never understood. So are you really saying that? Or are you just saying should you get back to a 2%? Are you really saying you should get back to that line? That's kind of what worries me.
No. So we're not saying that we should back to the line at this time. I'm not saying it, but we had a discussion among us, and so I'm not saying who's saying what. I don't want to put words in other people, but some of us said, the inflation target should be really symmetric, so it should not be like the European Central Bank, close by below. We should be, so if you're ready to undershoot, you should also be ready to overshoot. And therefore, if you think that you implement policies which you might risk to overshoot, that's fine. But then when you look at all the forecasts of the Fed, you never forecast on overshooting. You always, so that's, so there was in that sense.
Without having been privy to their discussions, I would just note that our colleague Angel Ubide had a book we published a couple months ago in that spirit.
Yeah.
Maybe that was one of the things that came up. I don't know.
Hi, Prakash Langani from the IMF. Ugo, your last comment started to pick up on what I was going to ask, which is whether you've looked at the inflation forecast errors that were being made over this period by the major central banks or by international organizations like the IMF or BIS or OECD. I'm wondering if looking at those forecast errors might help discriminate against the we don't understand what's going on with inflation hypothesis from the others that you investigate.
No, we did not analyze that in detail. So we had some discussion along the line of what I mentioned, but we didn't have any analysis of that.
Just for our audience, both here and on the web, Ugo or Prakash or Joe, are any of you aware on some of a good recent study looking at those issues? I mean, I know a lot of people have put out the graph saying, oh, the Fed and others all got the forecast wrong, but I don't know of anything that's gone beyond that as yet.
I mean, I haven't seen a report. I had a kind of motive behind asking. I haven't seen a systematic analysis. My motive in asking the question was that at the Independent Evaluation Office of the IMF, we are doing a study of the effectiveness of IMF advice on unconventional monetary policy. So we will be doing a study of inflation forecast errors to see how well the IMF and others were assessing the effectiveness of these policies in real time. I was hoping that Ugo would have saved me some work, but not.
Well, we'll look forward to hosting you when that's ready, and maybe Ugo can be a... Yeah, you'll hold me to that. And maybe if it's around AEA meetings again, Ugo can come be a questioner of you as vice versa. Yes. Fair play. Please.
Jeremy Quenstead and Peterson Institute. Often, my understanding is that we understand quite well how the expectation of market participants react to monetary policy and the credibility of the central bank. What we have much less understanding of is the inflation expectations of households and firms in particular, which are the price makers. And so I wanted to know if the empirical exercise that you mentioned, was that based on the inflation expectations of market participants, or was that a finding that also applied to the inflation expectations of other participants?
Are you talking now about the paper with Ian? Or
the paper where you look at whether the deviation at T-1.
Yeah, so this is not for this report. It's some other work which I'm doing with the World Bank. There we look mostly at, we don't look at market. We look mostly at professional forecasters and IMF forecasts, just because we want to have a very broad series of countries, and we don't have So then we do the exercise for a restricted sample of countries using market, but it's mostly professional forecasters. So consensus and this type of things.
Anyone else have a question or comment? Yes, please. A microphone's coming.
Hi, I'm Tim Grosser. I'm from the New Zealand Embassy. I have a question about one of the complexities in which the environment of the last 10 years has created for central banking in terms of dealing with asset price inflation. So, I mean, we're all trained originally to look through any single one price, our central banks. I think New Zealand was the first country to put in an independent central bank and inflation targeting, look at the general price level. This is obvious. But our publics don't think like this. Now, and it can lead, as it has recently politically in my country, to strong public criticism of the central bank for, quote, failing to deal with, well, they don't call it asset price inflation. It's inevitably always about housing because nobody in the public complains about rising stock prices. So our central bank started to try to increase the OCR by small steps, had to reverse it because output gap was still there. It wasn't clear that it was the right policy framework, so our central bank governor reversed a couple of decisions. Meantime, as in Sydney and as in Melbourne in our part of the world, Auckland house price is Auckland's about 1.5 million people, so it's not all that small. Goes through the roof. This creates a huge political demand on whoever is the government, and I was a member of our cabinet for 7 years during this period. So our central bank was very conservative in using LVRs and other instruments of monetary policy, but I wonder whether in the course of looking at this low inflation environment and the innate tendency, of course, of low interest rate structures fueling asset price inflation in a single sector of the market, whether you and your experts have got any reflections on that for monetary policy. And I mean, at the end of this is a political problem. It undermines public support for inflation targeting and independent central bank.
Yeah, so our view, so we didn't go deep into this, but our view that so these are problems. So I live in Switzerland. We have housing problems. Canada is, you have Vancouver and Toronto is. So our view that this you should use macroprudential instruments for dealing with these things. So one thing in Switzerland, for instance, one thing they did, well, they changed the capital charge for mortgages. They change how much you can use of your pension fund for the down payment. So you have other instruments. So we don't think that it's something you achieve with the interest rate, but with other complementary measures.
Just for the sake of it, I want to strenuously agree with Ugo and take it one step further. I mean, there's a lot, as you're well aware, there is a huge amount of discussion of this, and not just between Geneva and Basel. Yeah. There's a lot of discussion in Auckland and Sydney and Canberra about this. There are previous years' Geneva reports that deal with this issue of asset price targeting, or not very directly, which I would be doing a disservice to Ugo and Charles Viplas and their colleagues not to mention. But the final thing I would say, the most important thing, is on macro-pru. I've been personally advocating for a while now that you not only want to take this out of the monetary policymakers' hands, you want to bind the hands of the policymakers. So that we have had for a long time, as you're aware, as many of the people who watch this kind of thing are aware, this debate about rules versus discretion in monetary policy. Debate's the wrong word, but talking about rules versus discretion in monetary policy. In my view, that's much more applicable to macroprudential policy. And so to the degree you can move to a rules-based macroprudential policy, automatic tax increases or decreases tied to the housing price cycle, automatic changes in the loan-to-value ratio, as you mentioned, the better. Our colleague Olivier Jean from Johns Hopkins and here at the Institute had a paper relating to this a few years ago. I gave a speech on this when I was at Bank of England a while ago now, and I reiterated this at the Federal Reserve Bank of Chicago ECB conference last year. again, for someone with, part of the reason I'm going to such length is someone with your distinguished political background, as opposed to us clueless central bank types, thinking about how much temptation there is for the political cycle and these pressures to get involved in macroprudential decisions about real estate. It's not easy, but I think it's worth trying to imagine if there's an argument for central bank independence on monetary policy, there's an argument for somebody having some kind of automated rules-based way of dealing with these things. Then there's the technical questions whether it works or not. But I feel very strongly with the issue you raised that it's very hard to make a credible commitment in this area if you allow any discretion. This will be our final question, please.
Mike Prell, unaffiliated. I think you touched very briefly at one point in your report on the variety of possible price indexes you could employ in your analysis, but don't go very far in that. And I suppose at some level one could consider the possibility that some of the models that you test and employ in your analysis might be better suited to some variables than other definitions of general price level. But aside from that, in the recent period, the last several years in which I think you have this focus on inflation coming in below expectations and below targets, that's also a period in which we've had this discussion about very low productivity growth and possible price mismeasurement. Some people think that's a really big deal. People who might be regarded as technicians and experts in this tend to say it's not a big deal, but I'm wondering whether you gave any attention to that discussion in evaluating just how prices have been performing relative to model expectations or policy targets.
So we don't have a discussion in the report about price mismeasurement, but we had a similar question when we presented the report in Geneva. And basically the answer that we gave is that there is clearly price mismeasurement, but we don't think that, first of all, if the price mismeasure, okay, this is difficult to say, mismeasurement.
It's difficult for everyone.
It's constant, that doesn't matter for inflation because it just has a level effect. Of course, it can change, but we don't feel that the rate of change of mismeasurement is as large enough to justify to be relevant, over this period of time. So that's our feeling. Technological changes is a little bit like globalization. Again, you can have a level effect, but
yeah. Okay. Right. Well, I think we've come both to the end of our time and our list of questions. Please join me in thanking Professor Ugo Panizza of the Graduate Institute in Geneva for 3 reasons. First, for coming here and being so gracious with his presentation and his engagement with all of us on a substantive basis. Second, for he and his co-authors, including many mutual friends, who put together a great report that is thinking big picture about the stability of inflation in ways that we need people to do. And thirdly, that he and Charles Viplage and their colleagues at the International Center for Monetary and Banking Studies continue to support the Geneva reports and to convene such good experts and such good topics. Thank you very much, Ugo.
Thank you very much, Adam.